in the desolate, gray shipyards of South Korea's Jeoji Island and Japan's technical hubs, a silent tragedy of capital is unfolding. 6 ARC-7 class icebreaking LNG tankers, miracles of maritime engineering, each costing nearly $500 million, sit idle. They are the most expensive commercial vessels ever constructed, intended to be the crown jewels of Russia's Arctic expansion. For the U.S. Treasury and Western strategists, these ships are frozen assets, a $3 billion hostage in a geopolitical war of nerves. However, while the world focuses on these stationary hulls, a far more volatile signal is flashing on terminal screens in London, New York, and Hong Kong. As of early 2026, silver has shattered the $80 per ounce mark, a staggering surge that has caught the retail crowd and institutional shorts completely off guard. To the uninitiated, these two events, stranded ships in the Arctic and a silver squeeze in the futures market, seem worlds apart. But as a hedge fund manager looking at the macro grid, I can tell you, they are part of the same circuit. The Arctic is no longer just an energy province. It has become the vault of the North, the source of the world's most critical minerals, and the laboratory for a post-dollar financial order. Today, we are decoding how the blockade of $3 billion in shipping assets became the catalyst for a commodity-backed revolution that is pulling the rug out from under the Western financial system. The conflict on the Guidan Peninsula has evolved from a simple trade dispute into a full-scale maritime hot zone. The West's strategy was predicated on technological denial, by blocking the delivery of specialized tankers and prohibiting the export of liquefaction technology. The G7 believed they could turn Russia's Arctic LNG 2 project into a stranded asset. The siege of capital, Hanwha Ocean and Mitsui Oesk, are caught in a legal limbo. They have built ships they cannot deliver, for a client they cannot charge, and for a route that only that client uses. This $3 billion in trapped capital is a gaping wound in the balance sheets of these maritime giants. For a time, it seemed the sanctions were working. Production at Arctic LNG 2 reportedly halted in late 2024 as storage reached capacity, the countermove. But Moscow did not play by the rules of the 20th century playbook. In late 2025, the Alexei Kosygin, the first domestically produced ARC-7 carrier from Russia's Zvezda shipyard, began its sea trials. This vessel isn't just a ship, it's a middle finger to the G7. It was built using a hybrid of reverse-engineered Western tech and Chinese propulsion systems, proving that the technological blockade has a shelf life, the Kinetic Turn. The tension reached a breaking point in January 2026. U.S. naval and Coast Guard forces intercepted the Marinara in the North Atlantic and the Sophia in the Caribbean. These vessels, operating under the Shadow Fleet flag, were moving sanctioned energy and minerals. This marks a historic transition. The West has moved from financial sanctions to kinetic interdiction. When you start boarding ships in international waters, you are no longer managing a market, you are managing a war. Why silver is the strategic metal of the Arctic? To understand the price surge to $80, we must look at the industrial reality of the Arctic. Silver is the secret ingredient of the Northern Sea Route, NSR. In the extreme sub-zero temperatures of the Siberian coast, conventional electronics fail. Silver, with its unmatched thermal and electrical conductivity, is essential for the high-end sensors, GPS arrays, and specialized propulsion systems required for icebreaking tankers. Furthermore, the Arctic is the world's next major source of silver and cobalt. Russia is consolidating its position as the fourth largest holder of these critical minerals. By pivoting the NSR into a trans-Arctic transport corridor, Moscow is now bypassing the Western-controlled Suez Canal to deliver these raw materials directly into the manufacturing heart of China. The silver squeeze isn't just a speculative bubble. It is a supply chain panic as the West realizes that the vault of the North is being locked from the inside. The logistics of the Shadow Fleet. The Shadow Fleet has matured. In 2025, over 100 sanctioned vessels traversed the NSR. This is no longer a collection of rust buckets, as described by the mainstream media. It is a sophisticated parallel logistics system, AI's obfuscation. These ships use advanced spoofing technology to project fake locations, allowing them to load gas and minerals while appearing to be in the Mediterranean. Non-dollar insurance. These vessels are insured by state-backed consortiums in Russia and China, rendering the Western price cap and insurance bans irrelevant. The icebreaker gap. Russia maintains over 50 icebreakers, while the US operates only 2 aging heavy vessels. In the Arctic, sovereignty belongs to whoever can move through the ice. Currently, that is not the United States. The seizure of the Marinara was a demonstration of financial hegemony, but it may have been a Pyrrhic victory. Every time the US uses the dollar-based maritime order to seize physical assets, it triggers a bank run at the nation-state level. Flight to hard assets. Central banks across the global south are watching. Their response: a massive diversification away from US treasuries and into physical commodities. This is the fundamental driver behind the $80 silver and the gold rallies of 2026. If your dollar-denominated assets can be seized on a whim, you don't own them. You're just renting them until the landlord changes his mind. The BRICS unit. We are now seeing the pilot launch of the BRICS unit. This is not a common currency like the euro, but a digital trade settlement mechanism. Crucially, the unit is proposed to be backed 40% by a basket of gold and silver, and 60% by the currencies of the member states. The Arctic LNG and mineral trade is the real-world laboratory for this system. Contracts are being settled in yuan, dirhams, and rubles, completely bypassing the SWIFT messaging system. Peru, for the first time in 80 years, a major global trade route is being operated entirely outside the reach of the New York banking system. Perhaps the most cynical part of this 2026 landscape is the role of Europe. Publicly, Brussels condemns Russian aggression and supports the blockade. Privately, the data tells a different story. In 2025, the EU actually increased its intake of Russian LNG from the Yamal project to over 76% of total exports. The irony is thick. While the US Navy seizes Russian-flagged tankers, European ports in Belgium and France serve as the primary logistics hubs for Russian Arctic gas. The tankers that keep Yamal operational are managed by British and Greek firms. The West is effectively financing the very shadow fleet it is trying to dismantle. This internal contradiction in the sanctions regime is the smoking gun that proves energy security will always trump geopolitical virtue signaling when the winter sets in. The $3 billion in ships sitting idle in South Korea are a relic of a financial era that is melting away. The power shift we are witnessing isn't just about who owns the tankers, it's about the death of the unipolar financial system. The question for 2026 is no longer if Russia can survive sanctions. The question is, can the Western financial system survive the loss of its monopoly over the world's most vital energy and mineral routes? As silver pushes toward $100 and the Northern Sea route becomes a commercial reality, the message to investors is clear. The era of paper wealth is being challenged by the era of physical reality. The Arctic is the front line, but your portfolio is the battlefield. If you are still holding 100% of your assets in a system that relies on the rules-based order, you are essentially a passenger on a ship headed straight for the ice. The ships are moving. The vault is open. The rules have been rewritten in the frozen waters of the North.
The markets are hemorrhaging. If you looked at your portfolio this morning, specifically at the precious metals sector, you likely felt that familiar sickness in your stomach. Silver, the asset that was supposed to be the ultimate hedge against chaos, the metal that literally powers the green revolution, just took a massive 4.6% nosedive in a single session. The mainstream media is already churning out the standard excuses. They are calling it a technical correction. They are blaming it on margin hikes in a global liquidity crunch. On the surface, the math checks out. But ask yourself this: why would the price of the most critical strategic metal on Earth collapse at the exact moment global geopolitical tension is at its breaking point? Why in January 2026, with inflation still eating away at the dollar and supply chains fracturing, is silver being sold off like it's worthless? Here is the uncomfortable truth. This isn't a sell-off. This is a shakeout. You are witnessing a calculated, cold-blooded transfer of wealth from the impatient retail investor to the institutional giants. And looming behind this crash is a silent, brutal economic war between Washington and Beijing over who controls the future of energy. Today, we are dissecting the silver bloodbath. We're going to show you why this margin call was a trap and why the smart money is buying while you are panic selling. Let's examine the crime scene. On January 4th, silver prices collapsed, shedding nearly 5% of their value in a blink of an eye. The catalyst, according to reports surfacing from markets like Egypt and rippling globally, was a sudden, aggressive increase in margin requirements. For those of you who don't trade on leverage, let's simplify what a margin hike actually represents. It is when the exchange, the house, suddenly changes the rules in the middle of the game. They tell traders, to keep your position open, you need to put up more cash right now. Most retail traders and over-leveraged speculators don't have millions in liquidity sitting idle. So what happens? Forced liquidation. The system automatically sells their positions at market price to cover the debt. This creates a cascade effect. One sell order triggers another and another, creating a vacuum where the price free falls because there are no buyers at those immediate levels. This is a textbook liquidity squeeze. But here is the anomaly. Usually margin hikes happen after volatility spikes to protect the exchange. This time, the hikes seem to preempt the volatility. It feels coordinated. It feels like someone wanted to flush the leverage out of the system before the next major move. While the paper price on the COMEX crashed, try buying physical bullion at this spot price today. You can't. The premiums are skyrocketing. This divergence between the fake paper price and the real physical asset is the smoking gun. To understand why silver is crashing while the world burns, we have to look at the macroeconomic chessboard. This isn't about jewelry demand. This is about the economic Cold War between the United States and China. The industrial vacuum. We are living in an era where silver is no longer just money. It is a strategic military and energy asset. Solar panels, electric vehicles, advanced missiles, and the next generation of semiconductors, they all require silver. It is the most conductive element on the periodic table. You cannot build the future without it. China currently dominates the processing and refining of these strategic metals. They control the solar supply chain. The United States knows it is behind. Both superpowers are desperate to stockpile strategic resources. Now, think like a predatory hedge fund or a strategist in Beijing. If you know you need to buy massive amounts of silver for the next decade of industrial production, do you want to buy it at all-time highs? No, you want to buy it cheap. The net zero desperation and bank manipulation. Consider the timing. We are deep into 2026, the critical threshold for global net zero mandates. Western solar manufacturers and defense contractors aren't just buying metal, they are fighting for survival. If silver prices run free to their true value, their entire business model collapses. This crash serves as a coordinated reset for these giants. By triggering these margin hikes, the bullion banks created the necessary liquidity to cover their own dangerous short positions without spiking the price. They forced you to sell so they could exit their bad bets. Moreover, this suppresses the one indicator that exposes the dollar's true weakness against the yuan. It is a masterful, ruthless bailout of the Western establishment, funded entirely by your stop losses. The tale of two markets. This is where the plot twists. While the Western paper markets dump contracts, the Shanghai Gold Exchange, SGE, has been seeing massive physical activity. The East is draining the West's vaults. Every time the price drops like this due to a margin event, we see tonnage move from London and New York vaults into Asian reserves. China is likely laughing at these margin hikes. They are taking the physical silver, thanking the Western banks for the discount, and using it to cement their dominance in green technology manufacturing. We are seeing a bifurcation of reality. The West trades paper silver to manage inflation expectations and protect the dollar. The East trades physical silver to dominate global industry. The crash you saw yesterday, that was the friction between these two tectonic plates grinding against each other. So what happens next? The dust will settle. The weak hands have been washed out. The leverage has been flushed from the system. What remains is a market with zero fat, driven purely by physical scarcity. The global supply of silver is in a structural deficit. Mines are aging, ore grades are falling, and demand is exponential. The laws of physics and economics dictate that eventually the price must reflect reality. You cannot print silver. You cannot magic it out of thin air. When the paper manipulation breaks, and it will break, the move to the upside won't be a gradual slope, it will be a vertical line. This is the prelude to a short squeeze of biblical proportions. If you sold yesterday, you did exactly what the institutions wanted. If you held, or better yet, if you bought the dip, you were aligning yourself with the strategic flow of capital from paper to physical. This wasn't a crash, it was a clearance sale for the elites. The question is, did you panic or did you prepare? Stay liquid, stay skeptical.
China has just locked the vault. Gold has physically vanished from American shelves at $4,500 an ounce. And the biggest bullion dealers in the U.S. just admitted they are completely sold out of silver. Welcome to January 2026. While you are celebrating New Year's, the global financial system quietly broke. We have confirmation that Beijing has restricted silver exports, effectively choking the Western supply chain. The banks tried to crash the price on December 30th with a massive margin nuke, but it failed. The price didn't drop, it solidified. Experts are now projecting $100 silver within 90 days and $150 by year-end. If you are holding paper dollars, you are standing on a burning bridge. And today we expose the great squeeze that nobody is talking about. To truly understand the magnitude of this crisis, we have to look away from the manipulated charts on Wall Street and look at the forensic evidence from the ground level. We have analyzed a transcript from a veteran bullion dealer in the United States, a shop that has been operating for exactly 10 years as of this week. Their testimony provides a terrifying glimpse into the reality of the supply chain. Here is the situation on the ground as of the first week of January 2026. Gold is trading at over $4,500 an ounce. Just a few years ago, people said $2,000 was the ceiling. Now, at $4,500 plus heavy premiums, dealers are reporting zero inventory. The shop owner admitted that even at these historic highs, they cannot keep gold eagles or buffaloes in stock. If they manage to buy 4 or 5 coins from a walk-in customer, those coins are sold and gone within the hour. But the situation with silver is even more volatile. Silver has rallied an astounding 148% throughout 2025. We entered the new year with silver holding firmly above $70. To put that in perspective, just a year ago, the experts were calling for $28 silver. The dealers on the ground, however, saw this coming. They predicted $42, and the market blew past that to hit $72, and even spiked to $84 at the peak. What is happening right now is a phenomenon known as a liquidity squeeze. On December 30th, the COMEX, the primary futures exchange where the price of silver is supposedly discovered, executed a margin hike. This is a tactic used to flush out leverage. They raise the cash requirements to hold a contract, forcing traders to sell. The paper price flashed from $83 down to $70 in a matter of hours. The mainstream media called it a bubble bursting. They told you the rally was over. They told you to sell, but listen to what the dealers witnessed. When the price dropped on the screen, the physical buying didn't stop. It accelerated. The dealer noted that on New Year's Eve afternoon, while the paper price was bleeding, there was active buying. They bought everything they could. The shop owner confessed, "We were completely out. We were able to buy some later that morning, but it just doesn't stay." This is the critical signal. When the price drops and inventory vanishes, you are not in a bear market. You are in a bear trap. The whales, the high net worth individuals and the family offices, used that engineered crash on December 30th to sweep the floor. They took the last cheap silver off the market. The retail crowd, the average person, is still asleep. They think $70 is too expensive. They are waiting for a pullback to $50. They don't realize that $50 silver is gone forever. When the Chinese export ban fully bites in Q1, the price isn't going to $80. It's going to 3 digits. Now, we need to zoom out. We need to connect the dots between that empty shelf in Oregon and the geopolitical chessboard in Beijing and Moscow. Why is this happening now? Why has the supply chain suddenly snapped? This is what I call Operation Silverwall, the China connection for decades. The West has been comfortable letting China handle the dirty work of refining. We ship them the ore, they refine it, and they ship us back the .999 fine bars. It was a convenient arrangement, but on January 1, 2026, the game changed. Intelligence reports confirm that Beijing has implemented a soft embargo. They haven't announced a total ban on CNN. They are smarter than that. They have implemented a new licensing regime for the export of strategic critical minerals, including refined silver. They are making it administratively impossible to get metal out of the country. You have to understand the leverage here. China controls between 60% and 70% of the world's refined silver capacity. They are the bottleneck. By tightening the screws on that bottleneck, they are creating a supply vacuum in the West. Why would they do this? Because they need the silver. The net zero trap. The United States and Europe have spent the last 5 years aggressively pushing a net zero 2030 agenda. They want to electrify everything. They want a solar panel on every roof, an electric vehicle in every driveway, and a 5G tower on every corner. Here is the fatal flaw in that plan. You cannot have a green revolution without silver. It is physically impossible. Silver is the most conductive metal on Earth. It is essential for solar photovoltaics. It is essential for EV circuitry, and it is essential for the AI chips that run the whole system. We are currently in a 6 to 7 year structural deficit. The Silver Institute's data confirms that. Since 2021, the world has consumed significantly more silver than it has mined. We have been eating into above-ground stockpiles. The vaults in London, LBMA, and New York COMEX have been drained to historical lows. Now, China has looked at the math. They see that the West is desperate for silver to build its military technology and its energy grid. So, they decided to keep the metal for themselves. They are weaponizing the supply chain. This is a perfect storm. You have declining mining yields, exploding industrial demand, and now, the primary refiner of the world refusing to export. The Russian and BRICS factor. It's not just China. We must look at the BRICS alliance. Russia and China have completely stopped buying U.S. treasuries. They are no longer recycling their trade surpluses into American debt. Instead, they are buying hard assets. Russia has even proposed a separate precious metals exchange for the BRICS nations, one that would completely bypass the London and New York pricing mechanisms. They know that the COMEX price is fake. They know it is determined by paper contracts, not physical delivery. By hoarding physical metal, the East is preparing to break the Western pricing monopoly. The mining crisis, some of you might be asking. If the price is $70, why don't the miners just dig more up? This is the tragedy of the mining sector. You cannot print a silver mine. It takes, on average, 10 years to move a project from discovery to production. It involves permits, environmental studies, infrastructure.